Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull, bear, point, and figure market breadth summary chart for April 8th, 2018. Market breadth. With this past week's market decline, our bull, bear, point, and figure ratio at 0.70 rose from 0.51 last week, declining within bearish territory. The total count of securities in bullish or bearish patterns increased fractionally to 2,693. The count of bearish stocks decreased 10%, while the count of stocks in bullish patterns increased 22%. The Pirls PNF Market Breadth Summary Chart shows us a market now 10 weeks in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the email version of the Pirls Stock Market Commentary on a weekly basis free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 85 points for the 14th decline in 25 weeks. At a negative 87.82 points, it continues below all 9 tops in the last 30 months and continues above all 5 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in accumulation mode on higher average daily volume. Momentum. The CCI 20 daily at a negative 84.02 is up from a negative 120.31 last week. At Monday 3/26 close, it had 6 days below zero for a change of Woody's direction to down. It came close at Thursday 4/5 close, but has not yet penetrated the plus or minus 50 range for a valid zero-line reject short entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 101 weeks ago, while the daily CCI 20 began a Woody's downtrend 1 week ago. The CCI 20 weekly declined to a negative 62.16 from a negative 12.41 last week, falling outside the plus or minus 50 range required for a zero-line reject long entry signal should the CCI 20 rise in the coming week. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: REITs, oil, and brokers on top. Some tech and S&P retail on the bottom. Bullish, REITs and oil continue in the top 5. Brokers has entered the top 5. Networkers has left the bottom 5. KBW Bank and CompTech have left the bottom 5. Gold and silver has left the top 5. Bearish, oil continues in the top 5. Semis, disk drives, and computer hardware continue in the bottom 5. Focus this week from www.zerohedge.com by Tyler Durden. Keep your seatbelts fastened. Here are Morgan Stanley's 5 late cycle warning signs. The following are some key points and charts. 2 weeks ago, we reported that according to the latest Bank of America Fund Manager survey, no less than 74% of respondents answered that the global economy is in, quote, late cycle, close quotes, the highest percentage in survey history, while at the same time respondents voiced the highest inflation expectations in over 13 years. As a reminder, when global growth turns south, coupled with inflation, you get stagflation. And when the result is an abrupt halt to the late cycle economic expansion, recession begins. It is therefore not surprising that with a record number of people convinced, and the market now too, that a recession may be imminent, that Morgan Stanley picked the topic of where in the economic cycle we are for its Sunday Start piece on what's next in global macro. As the bank's global co-head of economics, Chetan Iyer, writes this morning, while in 2017, quote, the global economy roared back to life as a synchronous recovery in developed DM and emerging EM markets propelled growth to a 3.7% annual average, close quotes. This is now decidedly over, having reversed rapidly in 1Q18, quote, as DM growth has moderated along the rising risk of protectionism, renewing concerns over the length of the global expansion cycle, close quotes. In fact, as we showed last week, the Global Economic Surprise Index just turned negative for the first time since July 2017. And as Iyer adds, the far, quote, more critical debate, in my view, is how long the business cycle has to run, close quotes. This is what the Morgan Stanley economist found. The U.S. and Japan are the primary drivers of the slippage in DM growth. Our U.S. economics team has noted that, quote, residual seasonality, close quotes, consistently distorts GDP, leading to weak 1Q growth. In Japan, colder weather has dampened private consumption in 1Q18. In Europe, despite moderating PMIs, 1Q18 growth is tracking at an annualized 2.5% per quarter. In China, our tracking estimate for 1Q18 is now 6.9% year versus our initial forecast of 6.6% year. Our tracking estimate for 1Q18 global GDP growth has drifted lower, but still stands at a 3.9% QSAAR. Cyclically, while we expect China's growth to moderate, we see DM bouncing back into Q, which, along with continued strength in emerging markets ex-China, should keep global growth well supported for the rest of the year. Here, Morgan Stanley shares a broader perspective on recent events and whether, quote, the business cycle in DM is coming to an end, close quote, repeating that the current cycle is clearly more advanced in DM and the U.S. is furthest along. Hence, where attention has rightly focused, the bank's global economic lays out the key parameters it is watching to see if the end of the business cycle is approaching. According to Iyer, the following conditions would be warning signs. Resources are stretched. The unemployment rate is very low and wage growth is at cyclical highs. Inflation rises slightly above the central bank's 2% goal. The investment cycle is becoming stretched, while corporate profitability is deteriorating. The private sector is leveraging aggressively and excesses are building. Central banks take real rates into restrictive territory, slowing demand and causing defaults. This is the piece of the puzzle that brings the business cycle to an end. So where does the U.S. stand in the context of these 5 signs? Here is Morgan Stanley's take. Unemployment gap in negative territory, but no significant wage pressures yet. Inflation heading toward but not overshooting central bank goals. Corporate sector profitability improving. CAPEX cycle still not stretched. Aggregate private sector leverage not that aggressive. Real rates not yet in restrictive territory. Needless to say, all these are subjective metrics, and if one had to pick one market-based factor, we would go back to the striking finding by J.P. Morgan, which we noted yesterday, according to which the market is now pricing in just 2 years before either 1. The Fed engages in a policy mistake, or 2. The Fed's end of cycle dynamics are unleashed, leading to a rate cut and eventually QE. Morgan Stanley's conclusion? Quote, "We recommend that you keep your seatbelts fastened." Close quote. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.